In this video, I'm going to talk about the unrealistic price movement expectations from new traders. Stay tuned. Hey traders, a very warm welcome to you. Okay, so I was reading a really interesting article and this really cemented in my mind what I've always thought along, the unrealistic price movement expectations that a lot of new traders have or inexperienced traders have. Even experienced traders sometimes going into a new market have these unrealistic expectations. So what do we mean by these unrealistic expectations? How does it affect us? How can we change it? And how can we improve it so that, again, we improve our bottom line, which is what we're all about here. Okay, so the first thing that happened was that people were interviewed who were kind of inexperienced traders, and they were in a trade and they said, hey, where do you expect this trade to go? And overwhelmingly, the majority of these new traders had an expectation that was much higher than experienced traders. And in reality, the time that hit that target there was some number out there, like it hit it 20% of the time. So in other words, they were really underestimating when they were asked, hey, give me a target that you think this price is going to go to. They would give a target of, let's say, 100 pips, and it would only reach that target 20% of the time, whatever time period they were looking at. And they asked experienced traders, and experienced traders would inevitably say something like 50 pips or 40 pips, and it would hit that target more like 80% of the time. So what do we kind of learn from that is that new traders are vastly over optimistic about where the price is going to go. But before we enter that, look at what happened when people asked them with stops. So they said, okay, you're in a position, where would you put your stop that it's not going to be hit? And newer traders would have a much tighter stop and it will be hit something like 50% of the time. And more experienced traders would have a wider stop and obviously it will be hit much less frequently. So we've got this kind of a skewed scenario where you've got someone who's taken a trade here, and the new trader, let's see the new traders in blue, would expect the price to go here and not go here, whereas the experienced trader, let me see if I can find my red pen for you guys, experienced guy was saying, okay, actually I expect the price to go here, we're still at the same level and my stop's going to be here. So you can see how different that is. And actually from a pure perspective of trading, you can see that that's just going to mess up your trading. If you're expecting price to go there and it just doesn't even go there, you're going to end up being frustrated with it. If you're expecting price not to go against you and it stops you out, you're going to get stopped out loads. So what do we take from that? The point is we need to kind of put our stuff into perspective. This artificial skew where we're so optimistic the price is going to go our way, but it's not going to go against us, is putting more weight on the fact that we believe we can predict direction right. Whereas more experienced traders are saying, hey, you know what? I might be right in this trade and I hope I am. However, I recognize that I'm going to be accurate all the time. There's noise in the market. We might ping pong around a little bit before we get going. And when we do get going, we might only go up 3/4 of the way. And they're allowing for the fact that this isn't the low point and that isn't the high point. So their entry isn't the low. They're probably saying, hey, even if my entry is kind of a third of the low, I still expect it to go down and then it's going to go up. So that range there is going to be my maximum allowed range. So you can see how it starts to shift your expectations. And unfortunately, if your expectations are way unrealistic, you're going to get stop loads and you might have a great strategy. But if your stop's too tight, as we know, guys, the noise is going to ping you out. It's going to ping you out. It's going to ping you out. It's going to be no good. Let me get my cloth here and get rid of this stuff. So how do we combat that? Well, the first thing is we need to look at something like the average true range to get an actual physical number that we know is true for the expectations of our day or whatever it may be. So if the average true range in a day is 100 pips, it's a good place to start with. We can use that as a benchmark. If it's 500 pips, it's a good order of magnitude. Same if we're trading on a 15-minute chart, an hourly chart. We can have an idea of the order of magnitude we're looking at. And then we need to say to ourselves, okay, let's assume we're on a day here. And let me pick a color here. I've got so many colors in my hand. Let's go with 100 kind of points or pips or whatever we are trading, whether we're trading a spread bet or we're trading a CFD or spot currency, whatever. So we've got 100-point range is the average true range of the day. In other words, the low and the high, most of the time we're hitting 100 points, sometimes a bit more, sometimes a bit less. If we work from that, so let's say we're looking to trade the whole range of the day. If we're saying we're looking to go long here, What we don't want to do is say, well, actually, I need a 100 pip target, because the chance of you getting the low of the day are going to be slim. Okay, and the chance of you, getting that full 100 pips are going to be low. So we need to kind of compress it a little bit and say 80 pips is probably right. But now we need to say to ourselves, okay, if we expect an 80 pip day range, which otherwise is a little bit less, but less than expected, but it's well within what we expect, so we're probably pretty much almost guaranteed to get that, assuming the average true range over the period is 100 points. Then we need to say, okay, well, actually, we could be 20 pips out. We could be 20 pips too early. This could go down 20 and then goes up 80, in which case it's going to be 60 from our entry. So now we're starting to become more realistic and expect that we're not going to get the low. This thing could go 20 against us. So let's have a 25-point stop. Let's assume that we're getting the trend of the day and we're okay with that. And this is then going to be a 60-point move from our entry. That whole range is going to be 80 with a 5-point cushion or whatever. I'm kind of making it up on the fly here, but you get the point. You're shifting expectations rather than saying, okay, actually I'm going to get the low of the day, so I'm going to have a 100-point target, which is unlikely to be hit, and I can't really afford to take much risk, so I'm going to have a 10-tick stop, 10-pip stop, which you're going to get pinged out at. All you're doing is shifting everything down a little bit. So you're saying, okay, my stop needs to be expanded and my limit needs to be kind of reduced, and working from that. Now, I'm not saying this is the right way to approach everything, because very often you want to be on a trade where you're holding it for multiple days, you're swing trading it, you want to capitalize on an explosive move. I get that. But the point is, if we understand where our weaknesses come in as a trader, i.e. we underestimate the distance of the stops, the stop distance, so we assume that we're going to get away with 10 ticks or 15 and it goes 50 or whatever, and we overestimate how far it's going to go in one move before it comes back and starts testing different ways, then we can frame it a little bit differently. We can start to shuffle things around. And if this becomes a little bit uncomfortable for you in terms of risk reward, what we can do, guys, is we can say, okay, well, actually, let me put a limit 10 pips under where I was going to go. And if you find, and then kind of say, okay, well, actually, I was going to go in here, let me have a limit in here, and then keep things where I am and give me a little bit more room there, 17 and 15 going on the numbers we're using before. And in that case, it might work a little bit better for me. So it's a kind of little trick we can use. Of course, that's not going to work all the time, because you start moving it down too far, you're missing the point of the trade. You're trying to be good at getting the entry right. But the point of this video and the point of this comment, guys, is that if we recognize what we are vulnerable at, where our vulnerabilities lie, even if you're an experienced trader as well, recognizing that this is where we can slip up and we can be over optimistic with things and we can, misjudge things, and then just adjusting things to suit. And if we do that, then we're going to incremental success, and that's exactly what trading is all about. Little incremental success, recognizing the weak spots, recognizing the strong spots, working on the strength, working on the weaknesses. Combined together, we can make more money at the end of the day. All right, guys, thumbs up if you like this video, comments in the comment section below as always, and take care, good trading. So see you in the next video. Keep the risk managed. Bye-bye.